The previous video established what credit is and why the system exists. This video goes inside the mechanics. Your credit report and your credit score are two distinct but related things that people often conflate, and understanding the difference between the matters because they serve different purposes, are used differently by lenders and institutions, and require different actions when something goes wrong. This video covers both in full: what a credit report contains, how a credit score is calculated, what the score ranges mean in practice, how to obtain and read your reports, and what to do when the information in them is wrong. Your credit report is a detailed record. It is a document maintained by each of the three major credit bureaus, Equifax, Experian, and TransUnion, that contains the full history of your credit-related activity as reported by the lenders and institutions you have dealt with. The report is not a score. It is the underlying data from which scores are derived, and it contains far more information than any single number can represent. Understanding what is in your credit report is essential because errors in that underlying data affect your score, and errors are more common than most people realize. A standard credit report is divided into several sections. The first is your personal information. This includes your name, current and previous addresses, date of birth, social security number, and employment history as reported by lenders. This section does not affect your credit score, but it is worth reviewing because errors here, such as someone else's information appearing on your report, can indicate mixed files or identity theft. A mixed file occurs when the credit bureau accidentally merges information from two different consumers into a single report, typically because of similar names or social security numbers. It is uncommon but consequential when it occurs. The second section is your account history, also called your trade lines. This is the most substantive part of your credit report and the primary source of your credit score. Each account that has been reported to the bureau appears as a separate trade line. For each account, the report shows the name of the creditor, the type of account, whether it is a credit card, auto loan, mortgage, student loan, or other product, the date the account was opened, the credit limit or original loan amount, the current balance, the payment status, and the complete payment history, typically going back 7 years. The payment history section shows, month by month, whether payments were made on time, made late, or missed entirely. A single late payment leaves a mark that remains visible on your report for 7 years from the date of the delinquency. The third section is your inquiries. This lists every entity that has requested your credit report within the past 2 years. As established in the previous video, hard inquiries from credit applications have a small temporary effect on your score. Soft inquiries from your own checks or pre-approval screenings do not. Reviewing your inquiries is useful because unauthorized hard inquiries can indicate that someone is attempting to open accounts in your name without your knowledge. The fourth section is public records and collections. Public records include bankruptcies filed through federal courts, which are reported to the credit bureaus and remain on your report for 7 to 10 years, depending on the type. Collections accounts appear here when a debt has gone unpaid for an extended period and the original creditor has sold or transferred the account to a collections agency. Collections accounts are seriously damaging to credit scores and remain on the report for 7 years from the date the original account first became delinquent. Your credit score is derived from the information in your credit report using a mathematical model. The dominant scoring model in the United States is the FICO score, developed by the Fair Isaac Corporation. VantageScore is the main competing model, developed jointly by the three credit bureaus. Both models produce scores on a range from 300 to 850, with higher scores indicating lower credit risk. While the two models differ in their exact calculations and weighting, the factors they consider are similar, and behavior that improves your FICO score generally improves your VantageScore as well. The FICO score is calculated based on 5 categories of information, each weighted differently. Payment history accounts for 35% of the score and is the single most influential factor. It reflects whether you have paid your accounts on time. A single missed payment, particularly on a recently opened account, can cause a significant score drop. Consistent on-time payment over time is the most powerful force in building a strong credit score. Amounts owed accounts for 30% of the score. This factor measures how much of your available credit you are currently using, a concept known as credit utilization. If your total credit card balances are close to your total credit limits, your utilization is high, and this negatively affects your score. Keeping your utilization below 30% of your total available credit is the standard guidance, and below 10% produces the best results. Length of credit history accounts for 15%. This considers the age of your oldest account, the age of your newest account, and the average age of all accounts. Longer credit history is generally better, which is why closing old accounts can sometimes hurt your score even if you no longer use them. Credit mix accounts for 10%. This reflects the variety of credit types in your report, including revolving accounts like credit cards and installment accounts like loans. Having a mix of both is marginally beneficial, though this factor is not worth pursuing artificially. New credit accounts for 10%. This reflects recent hard inquiries and newly open accounts. Opening several new accounts in a short period signals elevated risk to the scoring model and temporarily reduces your score. Score ranges carry practical implications for the terms you will receive when applying for credit. Scores below 580 are generally considered poor and will result in denial by most mainstream lenders or approval only with very high interest rates and restrictive terms. Scores between 580 and 669 are considered fair and will access some credit products, but typically at above average rates. Scores between 670 and 739 are considered good and will access most mainstream credit products at competitive rates. Scores between 740 and 799 are considered very good and will access favorable rates across most products. Scores above 800 are considered exceptional and represent the strongest tier, qualifying for the best available rates and terms from virtually any lender. The spread in interest rates between a poor credit score and an exceptional one is not trivial. On a 30-year mortgage, the difference in rate between a borrower with a score in the low 600s and one with a score above 760 can be 2 to 3 percentage points. On a $250,000 loan, that spread translates to tens of thousands of dollars in additional interest paid over the life of the loan. On an auto loan, the difference can mean paying nearly double the interest rate. The financial value of maintaining a strong credit score is concrete and measurable in dollar terms. Obtaining your credit reports is free and straightforward. Under the Fair Credit Reporting Act, each of the 3 major bureaus is required to provide you with one free credit report every 12 months upon request. The official website for accessing these reports is the only federally mandated free report source. Various other websites offer free credit reports or scores, but may require signing up for paid services or provide different data. When you access your reports, you can request all 3 reports simultaneously or spread them across the year to maintain more regular visibility into your credit data. Reviewing your credit report requires knowing what to look for. The most important things to check are whether all accounts listed actually belong to you, whether the payment history shown for each account is accurate, whether any accounts are listed as open that you have closed, whether any accounts appear with incorrect balances or credit limits, and whether there are any collections accounts or public records you do not recognize. Errors in any of these areas can negatively affect your score and should be disputed. Disputing an error on your credit report is a formal process with a specific procedure. You submit a dispute directly to the credit bureau whose report contains the error, identifying the specific item you are disputing and explaining why it is inaccurate. You should include any documentation that supports your claim, such as payment confirmation records or account statements. The bureau is required under the FCRA to investigate the dispute within 30 days.